Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Fresh, well, I don't know about fresh, but from a press conference of the European Central Bank hosted by that eternal ray of sunshine, Christine Lagarde.
Yeah, very good afternoon to you, mate. Fresh is not the right word, even by Lagarde's own standards. Today was a very tedious and turgid affair, sadly. So, not on my usual sprightly form after having the life sapped out of me during that hour.
I've sat through a lot of those press conferences in my time when I was back at CMC. And I've got to say, I'm sure they could be truncated by quite some amount.
Probably about 59 minutes, yeah.
No, probably. I mean, just have a statement. I mean, it's so tediously predictable. And the journalists don't really ask them particularly challenging questions. And even if they do, they just dance around them.
Yeah, and of course the other thing is, especially with the ECB at the moment, they are pretty much done and dusted in terms of the easing cycle. So realistically, there's nothing to say. You know, there's not really any pertinent questions to be asked. Lagarde hasn't really got any fresh guidance to issue. Frankly, we're all just sort of there because we have to be there. No one actually wants to engage with it. But anyway, there's much more interesting things that have happened this week besides the ECB, mercifully.
Yeah, indeed. Another busy week for markets. More record highs for the US markets, FTSE 100 as well, on the back of some fairly decent earnings announcements, central bank decisions and a one-year trade truce between the US and China, which we can go into more detail about after the risk warning. So going to jump straight into that. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so we got the initial move higher this week because of the weekend news that the US and China had agreed a trade truce. That's been, I think, extended to 1 year. So what are the details, mate? Is it a case of taco once more?
Yeah, absolutely. In short, I mean, in many ways, the details almost don't matter. The market's kind of trading this in a binary fashion of, is there a risk of escalation or is everything sort of fine and dandy? And right now, it seems like things are kind of fine and dandy. As you said, there's a 1 year truce. China have said they're going to delay their rare earth export controls. They're going to be buying a whole load of soybeans from the United States. Of course, Trump has backed down on the 100% tariff threat and also cut the fentanyl-related tariff in half. So that's now 10% compared to the 20% that it was. Of course, if you ask President Trump, this is the best deal that the world has ever seen. The Chinese commentary is substantially more modest than that. But I think realistically, we're back in a situation where we were probably about 4 or 5 weeks ago, if not sooner than that, whereby the status quo has been restored. The rhetoric on trade is much calmer, it's much cooler, and market participants can begin to put tariff risks and the risk of escalation to the back of their minds again.
Here's the thing. People, joke about Trump always chickens out, but hasn't he to some extent achieved some of his primary goals, namely that China has dropped its curbs on rare earths?
Yeah, absolutely. Maybe not dropped. They've delayed them for a year. Yeah. But I fully agree with you. Again, we see it as an example of not necessarily chickening out, but the whole negotiating playbook, which is escalate to de-escalate. Throw a threat out there, make it outlandish, make it a huge number, make it grab attention, force the other side to come to the negotiating table and make it easier to extract concessions from the other party that you're negotiating with. And, yes, that strategy is a shock for financial markets because you have to discount the potential worst case scenario. But at the same time, it seems to be bearing fruit. It seems to get him the results. And all the time it does get the results, he's obviously going to carry on doing it.
Yeah, I think certain people in the markets use Trump as a rich vein of material to ridicule him with. But ultimately, look at the results.
Yeah.
He is high on hyperbole, absolutely.
Mm.
But the fact of the matter is, he generally gets the job done.
Yeah, absolutely. And so it has proved, once again. And I know a lot of people are rightly questioning the deal. Is there going to be this flow of rare earths out of China? Are they going to fulfill the agricultural and the soybean purchases that they've pledged to? And yes, those are important questions, and I'm sure they will get answered in due course in a number of months' time. But I think the important takeaway in the here and now is we've gone from the threat that 2 days' time, on the 1st of November, there could have been an effective trade embargo in place once more. Now that's not going to happen. So, of course, markets are going to react in an optimistic fashion to that.
And that's reflected in the gold price, which has continued to drop from the highs that we saw earlier this month.
And we're back under, we may be above it now, but we're hovering around that $4,000 an ounce mark once again, aren't we? Which seems to be becoming a bit of a sort of sticky resistance level, at least in the short term. And that makes sense. Gold, the slightly amusing thing which puts all of this into context is gold is down just over 10% from the all-time highs, but we're still up by 55% on the year, which gives you an idea of how significant the bull run in precious metals has been, and probably continues to be, really.
Yeah, but I think you've also got to factor in that we're going to be in November in a few days, and we're coming towards the end of the year. And given the fact that we've seen significant gains this year, not only in crypto, but in precious metals and in stock markets, you could well find out, or you could well see that further upside in the short term could well be limited by the fact that some people are starting to bank some of their profits for the year.
Yep, I would fully agree with you on that one. I think, and I know we got laughed at when we said this before, but I do think year end is going to come early in 2025 because, as you said, so many things and so many asset classes have rallied so significantly. People are going to be looking to take profits and ultimately not chase things into what could be a bumpy last sort of 6 weeks of the year.
Well, people can laugh, but at the end of the day, if you're a fund manager and you're sitting on a 50% return, why are you going to risk that?
Absolutely. You would be mad to, frankly.
Exactly.
Try chase an extra bit of alpha in the last couple of weeks of the year. What are you doing? Bank it, come back next year.
Yeah. So obviously, overshadowing, the trade talk has overshadowed what's been a big week this week for central banks. We had the Bank of Japan, we've had the Federal Reserve, who did cut by 25 basis points as expected. But there was a bit of divergence when it comes to the views of various policymakers. And Powell, I think, was unexpectedly hawkish. But you and I were talking off camera earlier about that. And to me, that's not a surprise that he's kept the prospect of staying on hold on the table, given the divisions on the FOMC.
Yeah, and as you said, the FOMC was split 2 ways in September. We had a portion of the committee voting for a 25 basis point cut, and we had Governor Moran voting for a 50 basis point move. This time, the committee was split in 3 directions. We had 10 voting for a 25 basis point cut, Moran voting for a 50 basis point move, and Kansas City Fed President Jeffrey Schmid preferring to hold the Fed funds rate steady. So as you rightly say, policymakers are becoming increasingly divided, not only on the appropriate magnitude of any rate cuts, but also whether rate cuts should be delivered at all. And I think it was perhaps surprising how aggressive Powell was in the press conference last night when he was saying that it's far from a foregone conclusion that they deliver a rate cut in December. But there's perhaps a school of thought that says, actually, well, he probably needed to be quite aggressive in order to actually get the market to sit up and take notice and reprice and build in that optionality that I think the Fed would want. We're, of course, 7 weeks away from that last decision of the year. Conceivably, depending on whether the US government can get its house in order, we could get 3 labour market reports by the time of that next Fed meeting. We'll have more inflation data, GDP data, etc., etc. Do the Fed want to sit there at the end of October with markets fully pricing a cut for December when the outlook is so uncertain, we don't know what data we're going to get, and the committee is clearly quite divided on the appropriate policy path? I'm not overly surprised that they actually want to have a bit more flexibility around things.
It makes sense. Anyway, before we go any further, I forgot to lay out what we're going to talk about. Um,
Well, there's so much to talk about this
yeah.
week that
So we dive straight into the Fed. So we'll park that for a bit. But obviously we've heard from the Fed. We've heard from Powell yesterday. The changes in the statement were significant. Just sort of realigning market expectations alongside, as you said, giving the Fed continued optionality when it comes to either holding or cutting in December.
yeah,
But we've also had earnings announcements from Meta, Microsoft, Alphabet. Obviously, we'll talk a little bit about the Azure outage of Microsoft following close on the heels of the AWS outage the week before. I mean, what's going on there? So we'll talk about that a little bit. Nvidia, $5 trillion valuation. Trying to get my words out.
Easy for you to say, mate.
Honestly, get the old teeth in. Talk a little bit about UK markets and the earnings this week, and also another IPO. Actually, another two IPOs. We've had Shawbrook today, and I think we've got tin food company Princes Group tomorrow. Results from HSBC, Shell, GSK, Unilever, Next, and WPP. An absolute nightmare from WPP. It seems to be going from bad to worse. Obviously, the Fed rate cut, and then we're going to look at. We talked about the ECB, so I'm going to skip over that.
Thank goodness for that.
Banks, NatWest Group on Friday last week, very solid set of numbers there. HSBC again, fairly solid set of numbers. Next third quarter numbers, another upgrade to profit expectations. And I always think that at some point that's going to end, and somehow Next continues.
Just rolls on, doesn't it? Yeah,
it does. They confound expectations by putting another guidance boost. Shell, and obviously we talked about Microsoft Alphabet, and then we'll look at the numbers for next week. Apple and Amazon are reporting tonight, so we'll probably cover them next week.
Yes, so sadly we don't have a crystal ball, and we can't tell you what those earnings look like before they come out.
No, but I think given the reactions that we've seen to Meta and Microsoft, the focus now, and we've talked about this on previous podcasts, we've talked about returns, and markets are now starting to get a little bit twitchy about the amount of money that these companies are spending on capex when it comes to AI.
Yeah,
and
you're right. Oh, sorry, go on.
And that's been reflected in some of the share price reaction when it comes to certainly Meta and to a lesser extent Microsoft.
Yes, no, absolutely. And we'll get onto that in a while.
Okay, so circling back to the Fed, we've seen a little bit of a boost in yields as a consequence of the markets repricing the prospect of a December rate cut. And that makes perfect sense. When you look at the 5-year Treasury, that was around about 3.5% this time last week. It's now 25 basis points above that low.
Yeah.
And this is not because we're not going to get a rate cut. It just means that the timing of the rate cut has merely been deferred. That's boosting the dollar. That's boosting Treasury yields. And it's given a little bit of a knock to stock market valuations. But ultimately, all it's doing is it's just basically causing a certain amount of repricing. It doesn't. It's not changing. It's not changing the direction of travel.
No, and also I would say we might not get a December rate cut. I don't think it's a certainty that they're going to hold rates in December. That very much depends on how data evolves. And I did say sort of slightly tongue-in-cheek during the press conference last night, as soon as we get a negative non-farm payrolls print, then Jay Powell is going to eat those words about, wanting to push back on the idea of a December cut.
If we get one.
Well, yeah, if we get a print at all, I guess is the bigger point. But I agree with you. Fundamentally, when you look at the Fed, they've got two main policy levers that they can pull. The Fed funds rate is on its way back to neutral. We've had 3 rate cuts last year. One of those was a 50 basis point move, of course. We've had another 2 rate cuts this year. Whether we get a cut in December, whether the next one's in January, frankly, I'm not entirely sure it matters. The direction of travel is back to somewhere around 3.25% sometime in Q2 of next year. You then look at the balance sheet. Well, the Fed ended balance sheet runoff last night. They brought that quantitative tightening process to a close. The balance sheet is probably going to bottom out around 20 to 21% of US GDP, and then will hold at that level because they're obviously going to be purchasing securities for reserve management purposes. So actually, you look at the sort of overall structure and you would go, well, this is still a very, very favorable environment for risk, for equities, for instance, and actually, the market is, of course, repricing the chances of a cut in December, but fundamentally, the direction of travel is still exactly where it was this time last week, this time last month.
And basically, halting the balance sheet runoff is essentially a form of easing anyway.
Yeah, effectively, and it could be argued, and I know the Fed are a bit loath to discuss this one, but it could be argued that the two policy levers have been working against each other for the last 18 months or so, because you've been easing in terms of delivering cuts to the Fed funds rate, but at the same time you've been letting treasuries run off your balance sheet, which is effectively a form of tightening. Now those levers are going to start to work in the same direction once again.
Which should be reflected, I think, in after the initial shock has worn off, and you've seen this knee-jerk reaction higher in yields. I think if you look at the 5-year yield at the moment, the highs this month have been around about 3.8%. We're still below those highs.
Yeah.
So what we're seeing is a rebound off the twin lows around about 3.5. If we stay below those peaks at 3.8, then the likelihood is that the market is still pricing in a cut, just not in December, and as you said, in the second quarters. So, to all intents and purposes, this is about timing, not about the end of the cycle.
Yeah, and also, you look at the equity space. I'm just looking at a chart now. You look at the S&P. We're trading at 6,900. We're trading where we were on Tuesday. The market has not exactly had a humongous move on the back of any of this, and actually, nor should it, I don't think, because, as we just discussed, in the grand scheme of things, nothing has changed that much.
Exactly. So this is essentially a market correction, a modest market correction, but it doesn't change the direction of travel.
Absolutely.
And I think that's the lesson that I think, sometimes you need to step back away from the headlines, away from the noise, and look at the longer term direction of travel. And the longer term direction of travel has not changed. It hasn't changed for stocks, it hasn't changed for yields, and it hasn't changed for the dollar.
Yeah, absolutely. It's that old thing about just zooming out, and it gives you a broader perspective on things.
Look past the noise and look at the trend that's still in place.
Absolutely,
and
that.
The S&P 500 did hold above the 50-day moving average. We talked about this a couple of weeks ago when we had the sharp correction lower.
Yeah.
As long as we hold above that 50-day average, the long-term trend remains intact.
Still remains to the upside.
And obviously the next target now, it's like a magnet. It's 7,000. And the market will want to test that.
Oh, I remember writing in a note, I'm pretty sure it was the end of last month, that if I was a betting man, I'd be putting money on us hitting that by year end. I didn't expect to be sat here a month later going, we'll probably hit it next week. But, we're, 100 points off. It does have that sort of air of inevitability about it almost.
And it's like the FTSE 100, isn't it? I mean, we talked about this, I think, at the end of June, July, and I said, could we go to 10,000? And I thought, well, we're up 12% already. And now here we are within 250 points of 10,000.
Yeah, I mean, I remember...
and we were below 9 at the start of the year.
Yeah, I remember during the summer being asked to put a year-end target on the FTSE. I think I threw out 9,600. And we've blown through that. The rally just shows absolutely no sign of slowing down, and frankly, why would it? Because on the whole, whether it be on Wall Street, whether it be in Europe, we've had a pretty good earnings season in the grand scheme of things. The monetary backdrop is becoming looser, as we just discussed, and also now that the trade uncertainty is starting to simmer down quite considerably, we're in an environment where you're looking at the underlying economy and things remain pretty resilient. So you'd almost say, what's the bear case? The only sort of bear case anyone seems to be able to come up with right now is we've rallied a long way, so it can't carry on. Well, yeah, I appreciate we have rallied a hell of a long way. We're up 40-50% from the bottom we saw in April, but just because something's gone up a lot, it doesn't mean it's automatically going to come down. There needs to be a catalyst for that to happen.
We're looking at the Nikkei 225. At the start of this year, it was below 40,000. It's now at 50. 51,500,
Yeah.
and it's been as low as 31,000 this
Yeah.
year. So, the Japanese stock market's on a tear, despite the fact that Ueda suggested that there could be a rate hike later this year.
Although the way I was characterising that to clients today was, Ueda has sort of left the door ajar to a rate hike before year end, but he didn't exactly try and push that door wide open, which is why we saw the yen. I think dollar yen's trading north of 154, or at least testing that mark. We're above it now. Of course, you've got a bit of divergence with a more hawkish than expected FOMC on Wednesday night. Put those two things together, the yen is weakening significantly in a very similar way, actually, to how the FTSE has an inverse relationship with the pound. The Nikkei tends to have an inverse relationship with the yen, and so that seems to be proving once more.
Yeah, if dollar yen goes up, the Nikkei tends to go up because the yen is weakening against the dollar. Anyway,
yeah.
Okay. So let's talk about UK markets. I think rather than jumping into US earnings, I think it's good to talk about that because we have had a rare bit of good news this week. Another IPO, actually today, in fact. Shawbrook Bank, Challenger Bank Shawbrook, trading at a modest premium to its listing price of 370p in opening trade. Brilliant news, about time, following on from, obviously, the Beauty Group, I think, at the start of the month, and we've got Prince's Group, the tin food company, Prince's Group IPOing on Friday, tomorrow, as we record this. So, hey, London's back, or is it?
Well,
I'm going to throw this open to you, mate, because I know that you've got a view on this. And I've got a view on it as well. But
I was going to say thank you for letting me deliver the bad news. You're absolutely right. All of that very, very positive, and it should be celebrated. However, in what has become worryingly familiar for the London market, it's very much a case of one step forward, two steps back, because we also had news this week that Doncaster's Group, which for those who are unaware is an engineering firm in the UK that's almost 300 years old at this point, is exploring an IPO of their own in New York. Despite the fact that the company is based in Leeds, it's also got a massive base in Sheffield. They are instead planning to list in the United States. Now, I know we spoke about this earlier in the week, but what's actually sort of annoyed me the most about this, perhaps, is that the firm haven't said anything. Bloomberg ran a very, very in-depth story on this earlier in the week. They tried to contact executives at the firm. They tried to ring the firm's office. They seem to be trying to hide under a rock or down the back of the sofa and not comment on these reports. We all know why they're listing in New York. They're going to get a better valuation listing on the New York Stock Exchange than they will here in London. There's going to be much more liquidity in their stock than there would be if they listed in London, and the volumes are going to be much higher than if they listed in London. As you rightly said earlier in the week, mate, it would actually be good to hear that from the proverbial horse's mouth, as it might actually give the government a sort of much-needed wake-up call on the reforms that the market needs. But sadly, they seem to want to do this more quietly, let's say.
I mean, for me, you need to come out swinging. You need to basically make the case, say, look, we'd love to list in London, but unfortunately, the barriers to us doing so are too high. What this week is basically going to deliver is it's going to give the government cover to do absolutely, I was going to say, be all. But it does. It gives them the cover to say, well, we've got IPOs. We've had 3 IPOs. We don't need to do anything. We need to abolish stamp duty, and that's really not the message that the government should be taking from this month's IPOs. It's a small oasis in a bloody desert.
Yeah, and it comes back to that whole thing about, the adage that one swallow doesn't make a summer. One or two IPOs does not mean that the London market is suddenly a great success. I mean, yes, we should be pleased that these companies have listed in London this week, Shawbrook and the Beauty Group, but it's 2 IPOs. Yes, there may be more to follow, Prince's, of course, but when was the last time we had any sort of decent number of IPOs in London? I haven't done the digging into this, I'll be honest, but I would wager we're probably going back pre-COVID.
But they're tiny, Michael. They're tiny.
Oh, in the grand scheme of things, yeah.
You're talking, this IPO today, 370p was the IPO price for Shawbrook. It's currently trading at around about 392p, as I'm looking now. values the bank at £1.9 billion. I mean, come on,
Yeah.
give me a break.
Yeah, no, I mean, let's be honest. Beggars can't be choosers, right? We've got to take what we're given at this point. But you're right. A £2 billion IPO is, yeah, it's not really worth popping the champagne over. Let's be honest.
And when I look at the London market, I'm also looking at the value of the pound. The pound's taken a nosedive in the course of the past few weeks. It's down 6% this year alone against the euro. I mean, if your benchmark is Europe, I think you're really struggling.
Well, yes, certainly given the issues that we're seeing on the other side of the channel that we all know about and have been very, very well documented indeed. But even cable has started to roll over in recent sessions, certainly since the FOMC on Wednesday evening. I do just wonder whether the market is actually starting to price in some of these, some of the stiff headwinds that the UK economy is going to face as we move into the run up to the budget on the 26th of November, of course.
Well, I think that's being reflected in some of the declines that we've seen in the pound since September. Because if you look at where cable was in September, we were at 137. We're now at 130, 130. We're below the 200-day moving average. And to my mind, it looks as if we could well break below that and head towards 130 and perhaps below that.
Yeah.
As people continue to lose confidence in the UK. And that in itself has problems or consequences when it comes to inflation.
Well, absolutely, because of course the weaker the pound gets, the more inflation you're importing, and thus the lower the likelihood of a Bank of England rate cut. And I mean, we'll discuss that later on because obviously we've got an MPC decision next week.
I mean, on the plus side to that, obviously it does give a boost to the FTSE and the dollar earnings of the companies there, but that doesn't really help people here in the UK and the Bank of England if they want to get the inflation back to 3% or even 2%. I mean, I think 3% is the initial target now.
Yeah, but also, just lastly on that, because I know we need to move on, but that again speaks to a long-running issue with the London market that 80% of the FTSE are earning their revenues overseas. It's not actually a UK index. It's just an index of large multinationals that happen to be listed in London these days.
Okay, well, let's look at the earnings this week. And to be quite honest, they've been fairly decent. I've got to say, NatWest numbers last week were very solid. I like them. Profits for Q3 rose by 35% to £1.7 billion, pushing profits for the year to date up to £4.35 billion. Q, another bank levy, I think, in the budget.
Yeah, most likely.
I mean, it's an increase of 25% on last year. I think, fortunately, even though that's been floated as an idea, it hasn't affected bank share prices to the same extent as perhaps it would have 5 years ago.
Yeah, and that is interesting actually, because you would have expected a little bit of downside, but the market does seem to have shrugged that off. I wonder whether perhaps participants are looking at it as a sort of trial balloon as opposed to a sort of serious suggestion. But I'm not sure I'd be as confident as that.
I mean, I was encouraged actually by both HSBC's numbers and NatWest numbers because loans to customers were up for both in the UK banking side, and deposits were up as well, except for the case in NatWest where they slipped slightly. So I think there is some evidence that loans are growing faster than deposits. And that suggests to me that people are borrowing more, perhaps for day-to-day spending.
Yeah, which is certainly something a trend that's worth keeping an eye on, because obviously we've been scratching our heads for a while now about why the UK consumer has been relatively resilient in terms of spending and in terms of some of the retail sales numbers. If that is coming due to a greater reliance on credit, then that could potentially be storing up some more severe issues for later down the line. So definitely something to keep an eye on. But I think on the whole, the way you should really look at things from a broader perspective is if banks are doing well, generally it's a pretty decent sign for the economy at large. And, whether it be NatWest or HSBC that we've had this week, also you look at last week where we had Lloyds and Barclays reporting, that there's really been, I would almost say, nothing to complain about in terms of the UK bank earnings that we've had over the last fortnight or so.
But I also think you need to also factor in the fact that UK banks are underpriced or undervalued relative to the US peers. So there's a certain element of catch-up, which means that things have to be particularly bad for there to be a setback.
That is very true.
UK bank share prices.
Yeah.
So, I mean, NatWest raised its guidance.
Yeah.
HSBC, higher provision with respect to commercial real estate on its ECLs, not only in Hong Kong, but also here in the UK. So, and the recent mortgage approvals and lending data did appear to suggest that lending was holding up reasonably well. So
yeah. The other thing with HSBC, just before we move on from that, is they're taking more provisions on the Madoff case. I mean, that was, how long ago was that? I think I was probably still in short trousers back then.
You were in short trousers, and it was 2011.
Maybe a baby grow.
Yeah.
It's a name none of us have seen for a long time.
That was a bit of a surprise, to say the least. But the share price is back at the highs that it was previously to the announcement that they were taking over the rest of Hang Seng. It's now popped up significantly higher. So, again, they announced the fact that they're suspending the buyback, but now we're back where we were prior to that.
Yeah, absolutely. The market's certainly cheering it, isn't it?
Yeah, absolutely. So they obviously thought, well, yeah, okay, they're taking this on the chin. Let's move on.
Yeah, indeed.
So let's move on. Next.
Delivered again.
Literally delivered again. I mean, they're already trading at record highs prior to their announcement this week, and they've popped even higher. Another guidance raise.
Well, exactly. I was just about to bring that up. We spoke last week and we were asking, are Next going to raise their guidance once again? Well, yes, they did. And actually, that's the fourth time in the last 8 months that they have raised their guidance. It's quite frankly staggering, the degree to which they keep doing this, and also the confidence that they have looking forwards as well. Because, of course, we are moving into, and I can't believe I'm going to say this, but we're moving into Christmas and that festive period now. And Next are clearly very, very positive about how the Christmas period is going to go for them. So positive, in fact, that they're going to be paying a special dividend as well. If you're a Next shareholder, there's really not a lot else you could ask for from these earnings.
£3.10 per share. Special divvy.
Yeah.
That's on top of the 87p dividend, which we paid earlier in the month. That's going to be paid at the end of January next year. And on top of the 87p dividend, which will be paid earlier in the month. So after the company publishes its retail sales for Christmas, which will be the first week in January. So, I mean, £1.13 billion will be their profit before tax. Another 30 million increase. I'm wondering how long it will be before the government decides to impose a windfall tax on retailers.
I was just about to say that, are we going to have a Next windfall tax as well as an oil and gas one and a banks one? I guess there was some chat earlier this week about supermarket profits. Oh, I mean,
I just thought to myself, my God, when is it bad? How much profit is too much profit? Supermarkets operate on wafer thin margins.
Yeah.
They need the profits to A, pay their staff, and to B, upgrade their supply infrastructure or their delivery infrastructure. What are these people on? What they've been smoking?
Well, it's a very good question. But you're absolutely right. And also the thing with supermarkets is we all know, because we do a weekly shop and because, we eat, that food prices have gone up. And they've gone up a hell of a lot over the last few years, and they keep going up. But that's because of other factors. That's because of the actual price of the raw materials is going up. For example, you look at agricultural commodity futures. I know Tesco have been in the news, well, certainly in a bit of a social media storm about this. Tesco's profit margin has been 4 or 5% for about 7 or 8 years now. This is very, very clearly not profiteering or opportunism from the supermarkets that are involved. It is actually just a case of food prices are going up and they are just being passed on along the value chain.
I mean, we've talked about this. Energy costs. What's the biggest cost to a supermarket? Those big delivery lorries that drive around the country.
Yeah.
Minimum wage going up, national insurance going up. People talk about food price inflation being in the UK 5%, 2% or 3% in Europe and 2 or 3% in Europe. Take a day off, guys. Have a look at what you've been criticising the government for over the course of the past 12 months. National insurance, packaging costs, packaging levies.
Yeah, that's come in, of course. Yeah,
that's come in as well. And then you've got energy prices, the highest in G7. Is it any wonder our food prices are basically trending ahead of the rest of the world when we've got a muppet government who don't understand the basic rules of economics?
Well, you're absolutely right, and of course the other thing to consider, you mentioned the minimum wage or the living wage or whatever it's called nowadays.
Yeah, living wage.
That, of course, disproportionately impacts lower salaries. Yeah, and of course retailers employ a larger proportion of employees on a lower wage than other sectors of the economy, so it's going to hit them harder. But yeah, anyway, let's move on before we go into a political rabbit hole.
Before I bust a blood vessel.
Well,
there's a vein there that starts to throb when I start to.
I was going to say, it's a question of who goes first, I think.
Yeah, exactly. Shell, decent set of numbers from them today. Bit of a meh reaction on the share price, but I think that's largely down to the fact that the shares aren't too far away from the highs that we saw back in May 2024, and they're still trading at a significant discount to their peers in the US, Exxon and Chevron. So that's still a live discussion when it comes to potentially moving that listing.
Yeah, that one certainly isn't going to go away. And actually, we get earnings from both Exxon and Chevron before the market open tomorrow on Friday, which is obviously worth watching. I guess the other notable point from Shell, their results were pretty strong, as you rightly said. They've announced a fresh buyback, $3.5 billion as well. So that's something to keep an eye on, and they're going to complete that by the fourth quarter earnings, which are due out sort of early next year, January, February time. So yeah, I think it's, as you say, they were trading near the highs going into the earnings report. Maybe it's just a case of the market really not having much to actually react to here.
I mean, the CEO, Mr. Sarwan, did basically say that if there was a continued valuation gap by the middle of 2025, although it's not a live discussion now, it would be a live discussion towards the end of the year, or we're towards the end of 2025 now.
Yeah.
So that is a discussion that's likely to come back front of mind at the start of next year.
And ultimately, it's something that becomes harder to ignore as time goes on. Ultimately, you think about the fiduciary duty that they have to their shareholders, which is to obtain the best valuation for the firm that it's possible to obtain. And if you were a shareholder or if you are an activist investor and you're going, we are performing as well as, if not better than, our peers listed in the United States, but there is this huge gulf in valuation, it becomes, those questions get asked more and more, and it becomes much harder to deflect away from those questions being asked. So, frankly, it's not surprising that topic is likely coming up again. And actually, the Shell are not the only ones. We've obviously spoken about Shell, BP with Elliott involved, AstraZeneca, of course, are one that we always bring up on this sort of topic. It's a sort of bit of a running theme at this point.
Yeah, and they're reporting next week. Right. WPP. We've talked about this before. They've issued another profits warning today. The new CEO, Cindy Rose, who used to be the UK chief for Microsoft and has only been in the company or been in a position 1 month. Talk about what a baptism of fire there.
Bit of a poisoned chalice, this one, isn't it?
Yeah, I mean, 11% drop in revenues in the third quarter to just under £2.5 billion. And they've downgraded their profit and revenue guidance from their previous forecasts, now trading at levels last seen in 1998.
Yeah, good year that. But
I wonder why that would be.
No comment. But yeah, I mean, it's grim. It's absolutely grim. There is really no way to sugarcoat that. I mean, as you said, the new CEO was talking about how their performance has been unacceptable. Well, yeah, we know that. What are you going to do about it? That's the key question. And if anything, it looks like things are going from bad to worse. They've slashed their sales guidance. There's a decent chance, you would imagine at this point, that they are going to fall out of the FTSE 100 pending the next rebalance. Certainly, if the share price doesn't recover in any sort of significant way, and there doesn't really seem to be much by way of a concrete turnaround plan that the market can really rally behind at this point. You almost ask yourself where this is going next, and it certainly doesn't seem like it's going to be bouncing anytime soon.
No, I mean, do you remember we had a conversation? I think it was in July or August or whenever it was when they last issued a profits warning. And I said, if it drops below 450, unless it gets back above there, then we could well be heading an awful lot lower.
Yeah.
We're now at 308p.
Yeah. And you sort of end up asking yourself, well, where's the bottom?
Yeah. I mean, that was the floor for me. And if it broke below that on a technical basis, there was always going to be a difficulty in turning that around. And so it proved. It did try and get back above there back at the end of July. It failed, and now it's just rolled. And now it's well below the 200-day. It's well below the 50-day. And at the moment, it looks as if it could fall further.
Yeah, it certainly isn't looking rosy, is it? Let's put it that way.
GSK, on the other hand, Emma Walmsley doing a great job there. I mean, I remember reporting on this back in 2022 when they span off Haleon to focus essentially on vaccines and less on the retail side of the business. And there's been a really strong performance, and it continues to go from strength to strength. R&D, significant process, strategic focus on the core business is basically bringing its own benefits and rewards. The share price has gone strongly higher and continues to do so by the looks of it.
Yeah, absolutely. And, there's not really a lot else to add to that, but it was that classic case of not only delivering a beat on all the metrics you look at, but a guidance upgrade as well. And of course, the market is going to cheer that result. It's a really, really good example of a company that's refocused on its core business, and is that strategy is bearing dividends for them.
So the big test for me now is the highs that we saw in 2024. Obviously, that was around about £18.
Yes.
18.20. It was £18.20.
We're getting back towards that now, aren't we?
We are now getting back towards that. I mean, there was the big drop back in 2022, which saw the shares hit multi-year lows, and we rebounded off them earlier this year. Now we're looking to retest those peaks of 2024. So for the key test for me, I think, when it comes to GSK, is can we get back through that and look to retest those peaks of 2022?
Yeah.
If we get through the 2024 peaks and fill that gap, which we saw as a consequence of that decline in 2022, because there was a big gap lower there.
Yeah.
Right. Let's talk Mag 7.
I was going to say, we probably should cover that, shouldn't we?
Yeah. Where do you want to start? Microsoft or Meta? Because both of them took a little bit of a shoeing last night.
Well, let's do Meta, because they've taken even more of a shoeing today. They're down about 12% when I last looked.
And the shares are below the 200-day moving average at the moment.
Which is a big level, of course, and even a technical analysis heathen like myself will recognise the significance of that. The earnings were soft across the board from Meta. They did, well, softish.
Revenues, Q3 revenues beat forecasts. Well, you remember the upper boundary was 50.5. They came in at 51.2.
True.
So that's a decent beat. I'm playing devil's advocate here. Net income took a huge
You are.
hit.
I don't like it. That's my job on this bloody show.
So what spooked them? What spooked the markets? Because revenues were a beat, and the Q4 forecasts were also well in excess of forecasts as well.
Well, one of the biggest issues is capex. They are continuing to spend on AI. There are some signs that they are beginning to monetize this, but they raised their capex guidance. Reality Labs, which is their AI division with a fancy name, continues to burn cash. I think it was $4 billion that it lost in the last quarter. And also, you're now starting to question, I think the market is starting to question, how are they going to finance this continued capital expenditure on AI? Because today they've announced a 6-part bond issue for, I think, about $25 billion.
Well, that's how they're going to finance it.
Well, exactly. That's how they're going to finance it, to which the market has sort of gone, well, okay, fine, but where is the return on this and when are we going to see it? Because in those earnings last night, there didn't appear to be much evidence of that.
No, I mean, and there was also a $15 billion tax charge as well. Which
that's obviously not going to help.
Hammered their profits, but that's a one-off, right?
They did say that was a one-off, and it was a non-cash charge as well, so it's more of an accounting thing than anything else.
So they raised their capex guidance, or the lower end of it, to between $70 billion and $72 billion. And I think the kicker here, Michael, wasn't so much the fact that they raised the lower limit of that to 70 to 72. It was the fact they were going to Zuckerberg said they were going to spend even more in 2026.
Yeah, and I think this is maybe a theme that the market is going to start to trade off. I think potentially is that, you know, what we saw probably for the last 12 months or so was more capex is good. Basically, the more you're spending on AI, the better it is, the better servers you're going to have, the bigger data centers you're going to have, etc., etc.
To a point.
Sorry?
To a point.
Exactly. And I think we might be getting to that point now where it's a case of, fine, we understand the arms race, we understand the argument, we understand increasing capital expenditure, etc., etc., etc. Where's the return? That's the key question that market participants are starting to ask. And I think companies that can demonstrate there is a return, like Alphabet, they are going to be very well rewarded. Companies that are unable to demonstrate a significant return on that, aka Meta, are going to potentially face some more headwinds.
Yeah, I think the thing here is, in the case of Alphabet, and we'll talk about them in a minute, they've got a much smaller market share.
Yes.
When it comes to Meta, so for example, which doesn't really have a market share and doesn't really operate in that space.
Yeah.
As in cloud.
Yeah.
But then you've got Amazon and Microsoft, who basically make up a good chunk of the cloud market. They're reaching what I would call the limits of their expansion, perhaps.
Yeah.
So perhaps the return there is likely to be less than, say, for a company like Alphabet, which has a much smaller market share.
And can grow that share.
And has much greater capacity to grow that market share.
Yeah. Yeah, that's a very interesting point, actually. And it is going to be interesting to see how the market trades this over the next 3, 6, 9 months, I think.
Because I'm looking at Meta's share price, and obviously we've seen a fairly decent outsized reaction over the course of the past couple of days. But year to date, they've given back an awful. I think they've given a good proportion of that back.
Yeah.
In the past couple of days. Microsoft, on the other hand, the share price reaction has been slightly less outsized, but the narrative, I think, still holds. And given the fact that Azure had an outage yesterday, a week after Amazon, suggests they have perhaps deeper problems that they need to identify. They need to manage their current infrastructure and make sure it's resilient and not to the exclusion of their future spend and, you know, going forward, their newer infrastructure.
Yeah, I think that's a very good point. As you said, Microsoft's down about 3%, 3.5% on the day today. The other thing that may be sort of limiting losses there is there was some positive-ish news on the OpenAI front earlier in the week in terms of their stake in the firm, which might be cushioning the blow a bit.
Because Azure revenue was up 39%, which was well above forecast. So they're still seeing some decent growth there. An 18% increase on last year of Q1 revenue of $77.7 billion.
Yeah.
But capex was higher than expected.
Yeah. And again, it comes back to that point of, is that capex monetized?
But they have said that they've got an order backlog.
Which obviously bodes well for coming quarters. So we'll see how they deliver on it.
And actually, Alphabet put a number on that order backlog. $155 billion.
Which, when you consider their quarterly revenue is 100 billion or just over 100 billion, is insane, isn't it?
Yeah, I mean, that was a record. Alphabet posted, I mean, we talked about this last week. I suggested that their forecasts for Q3 were 96. And I sort of said, well, maybe they're going to get 100.
And they did. Yeah.
They did. But they have raised their forecast as well. To $91 and $93 billion for its capex spend. But if you've got an order backlog of 155, then it's not hard to see that you've got the capacity to grow that. So that's probably why the market is asking less questions of Alphabet.
Yeah, than it is of the others, yeah.
Because they put a number on that backlog, whereas Microsoft didn't.
Yeah, they just sort of said there is one, but, well, what does it look like? Yeah. Anyway, should we do the week ahead?
Let's do the week ahead. Bank of England. Let's start with that.
Yeah. Well, they're not going to do a lot, are they? Let's be completely honest.
Do they think they'll do anything this year? I mean, judging by the reaction of the pound, the answer would be no.
Yeah, it's an interesting one because we have actually seen quite a significant dovish repricing in terms of policy expectations. I was looking before we hit record, and the swaps curve price is about a 2 in 3 chance that they deliver a cut by the December meeting, by year end. This is all seemingly off the back of the softer than expected September CPI report, which I say softer than expected, but it still came in at 3.8%. It's not exactly a cool number. I think the bigger issue, though, for next week's meeting is it's 3 weeks before the budget. You know, policymakers on the BOE will not know what is going to be in that budget. They won't know the degree to which it may hit economic growth in terms of the tax hikes that are going to be delivered. They won't know the degree to which any of those tax hikes could be inflationary as well. So I think they are going to want to err on the side of caution and stand pat. Certainly, remarks from a number of policymakers haven't really indicated any desire to deliver another cut just yet. If anything, you've had people like Megan Green and Hugh Pill saying they should probably slow down the easing cycle and skip a meeting. So I think it's very much going to be a case of the BOE standing pat, 7-2 vote, most likely, maybe 6-3 at a push. But you're really looking to December potentially, but I think that needs some real labour market weakness to force them to act then. My base case is we don't get anything until February.
Yeah, I mean, they've cut at every meeting where there's been an inflation report.
Yeah, since they started last summer. Yeah.
So December, there's no press conference. So are they going to cut then? They might if the wheels come off, but you know, I just they'll want to explain it. And if there's no press conference, I can't see anything before Feb.
Yeah, no, I'm with you on that one, and I think this does come down to maybe the BOE should just get with the times and have a presser after every meeting. Although I did complain quite a lot about the ECB press conference today, but yeah, they could move in December if they wanted to, but they do kind of box themselves in by basically only wanting to move when they have forecasts and a media opportunity to back that up. So yeah, I think as you were until next Feb.
I think if the budget had been this week, they'd have had cover to do something if they felt the need to. The fact that it's November 26,
it's a problem for them.
It's a problem for them.
Yeah.
And given the fact that the Office of National Statistics is still not doing the job that it's supposed to be doing, it's going to be very difficult when you look at the quality of the data. But having said that, this week's PMIs for October were fairly decent. Well, so fairly decent. The services was okay. The manufacturing was still pretty ropey, even though there was an improvement there.
Yeah, anyway. Absolutely. Although at least the ONS are giving us some data, which is more than we can say for the US at the moment.
True. I suppose bad data is better than no data.
Well, actually, I'm not sure. I'd rather no data, to be honest.
Okay, well, on the subject of data, we got the US ADP payrolls report, and it's interesting that they're now going to start reporting numbers on a weekly basis.
Yeah, I mean, clearly they're trying to sort of plug the gap that's being left by the fact that we haven't had any official US labour market data for some time, and we certainly won't be getting a jobs report next Friday either. No. The monthly ADP number, of course, fell by 32,000 in September. Now, there was a bit of a quirk around some seasonal adjustment in that figure, but still, again, more evidence that points to the US labour market stalling, points to the labour market losing momentum. And if you take what Chair Powell was saying last night at face value, it seems like there are some, if not many, on the FOMC that want to see further evidence of that stalling before becoming convinced that they should deliver another rate cut before the end of the year. So I think it could be one of those classic cases of actually bad news is good news from an equity perspective, whereby if we were to get a ropey ADP number, then actually that would see market participants ramp up their bets on further easing from the Fed, and it could actually underpin risk assets a little bit more, which is very, very counterintuitive. I appreciate that, but that's often the way these things work.
Well, you look at the last 4 jobs reports for ADP, we've only seen one positive month. So that's a significant slowing from the first 5 months of this year. Yeah. So obviously there is concern there. But the most recent weekly reports have shown that hiring has started to pick up. So it'll be interesting to see what the report tells us. Anyway, I mean, I've talked about it in my Substack, so you can read all about it on there. Manufacturing and services PMI reports, they'll just basically reiterate what we saw earlier this week with the flash numbers.
They're final numbers, aren't they?
the final numbers. We've got BP's third quarter numbers coming out, following on the back of Shell's this week or today, in fact. They've had a decent run of late in terms of the share price. So I think the bar here to a fairly decent set of numbers isn't that high.
No, I don't think it is. As you rightly allude to, what you would be looking for, though, is further signs of the company's turnaround plan, and that beginning to or continuing to bear fruit. I think that's going to be the market's main focus in these figures, as BP gets back to, frankly, being an oil and gas company as opposed to gallivanting around trying to fight climate change and rebuild rainforests and good knows whatever else they're doing.
Yeah, they're all noble sentiments, but what have you, they don't really cut the mustard. I mean, there's a review going on at the moment with the CEO and the new chair. I want to see evidence of progress on that.
Yeah, absolutely.
Other than that, if they can match Shell's numbers, and I'm still of the opinion that they need to stop buying back their shares.
Yeah,
they need to put that cash to better use. And
we've had that discussion on numerous occasions, haven't we? And I'm in full agreement with you.
And let's face it, if HSBC can suspend their share buyback program, their shares are now higher. You'll get an initial knee-jerk reaction lower, but ultimately it's about how you use that cash.
Yeah, and buying back your own stock is not the best use of it.
Not when you're raising your net debt profile.
Exactly. Yeah, priorities need to shift there.
They do. Okay, we got Marks and Spencer's. Obviously, they're still recovering from the effects of the cyber attack earlier this month. It'll be interesting to see whether or not the shares are back pretty much where they were in April. There's a bit of a barrier there at 4.15. It struggled to get through that 4.15. That's 415p, not 4.15 a time.
Just say you got an appointment to keep to or something.
Yeah. So it's been a fairly decent rebound. I think the bigger question here is that are they back on track from where they were before the share price fall off, and have they put all the problems of the cyber attack behind them?
Yeah, agreed.
AstraZeneca. Pascal Sorio is not a big fan of the UK, is he?
Well, rightly, given all of the issues AstraZeneca have had and the nonsense the government's been doing, and of course they recently changed their US listing structure.
Yes, so
which is a bit of a red flag.
Yeah, I think obviously we've had the cancellation of a further £200 million investment here in the UK.
Yep.
In September. So I think for me, it's not so much about the numbers. I think they're going to be pretty decent. Obviously, the agreement with the US government over drug pricing has boosted AstraZeneca. It's boosting Pfizer. Pfizer are due to report next week as well, which is one of AstraZeneca's closest US counterparts. Thing for me, I think, is how they see the business going forward. How are their new drugs performing, Tagrisso and Imfinzi? They both saw double-digit revenue growth in Q2. Well, has that continued in Q3? And what do they have to say about the prospect of shifting domicile?
Yeah, and
they report in dollars anyway, so what's to stop them?
Well, exactly, and they're definitely going to be asked about that on the earnings call, and as we discussed earlier on, it's going to become an increasingly difficult question to say no to.
Yeah. Diageo first quarter numbers. I'm struggling with Diageo. They should be doing better than they actually are. They've got a new CEO. There was a big row earlier about the new CEO's remuneration. And the shares are trading pretty much at the lows for pretty much the last 10 years.
Yeah.
They're supposed to put all these problems behind them, and yet shareholders are complaining about the new CEO's salary package.
Yeah. And, as you say, almost every time you look at the stock, it's another couple of % down on where it was before. We're well off those 4,000 pence highs that we saw back in 2021 and 2022. They are a distant memory, and it feels like it's going to take quite a lot to turn things around from here.
It does, but I mean, how low is too low?
Well,
I mean, their guidance...
Clearly we're not low enough because we keep falling, so...
But we did see a rebound in the aftermath of the Q2 numbers, but we've given that all of that back and more.
Yeah. So is it going to be a case of the same story? And I think that again speaks volumes in terms of sentiment. If we see a bounce on the figures next week and that's just sold into straight away, clearly that's a pretty ropey sign for the bulls out there.
Yeah, I mean, we're talking about an £8.5 million shares package that is said to have been allocated to this new. He's an interim CEO. He's not even. He hasn't even been confirmed in place. He was a CFO. He was a CFO. Apparently, he and Deborah Crew didn't get on. That suggests to me that maybe management or shareholders don't have confidence in the management.
Yeah, I think I would agree with you on that.
And how do you create that confidence?
Yeah,
We'll stop bickering about packages and get on with basically reforming the business.
Yeah, go and run the firm.
Yeah. Okay, so Diageo, bar's going to be low there. But the problem for me is that the die is set. The momentum is very much set to the downside. And it's really a question of how you turn that sentiment around. And at the moment, I don't see any evidence of that.
No, I would agree with you.
Right. JD Witherspoon, your favourite your favourite topic.
I don't know how that one stuck, but yes, go on.
I mean, I look at Tim Martin and I look at a guy who knows how to run a business. And since the share price peaks back in July, I've seen nothing in these share price declines that is warranted by the actual numbers themselves.
Yeah.
And yet here we are. We're trading probably about 15% off those July, August peaks at around about 645p.
For no real reason.
Well, I mean, there's always a reason. I just think that, perhaps he's had a decent run up from the April lows, 550 to 800. And we're slap bang in the middle of that now.
Yeah, and actually just looking at the chart, that 800-ish level was the high that we saw this year. It was also the high that we saw in the early part of 2024. It just feels like that's a bit of a sticky barrier for the market to break above. But we'll see if the earnings can be a catalyst.
I mean, he did make a great point about the additional costs that he's had to incur this year as a result of the recent tax changes, national insurance changes, tax changes, and obviously £7 million in non-commodity energy costs and extended packaging costs of £1.6 million. Again, this is businesses having to contend with higher prices, but he still, you still look at the revenues, that was up 4.5%. Profits are up 10.1%.
Yeah.
He's obviously running a fairly decent business there, and
it's a tight ship, isn't it?
It's a tight ship, and they don't appear to be getting the credit that they deserve. On the US front, we've only got really one company to speak of. Oh, well, obviously we talked about Pfizer.
Yes,
we've got Uber.
I'm not going to make a taxi pun. Don't worry.
Oh, that's good. Taxi. I can remember when Uber first IPO'd. And they actually said they couldn't see where they were going to make a profit.
Yeah.
But here we are, almost 10 years later. Yeah. So I think it was back in 2015, maybe 20. Actually, was it 2018, 2019?
I think it was 2018 because I remember it. So it can't have been that long ago.
That's true. And now they're back just below $100. And the IPO at 70, they went down to 20, actually 15. Since then, it's been pretty much a one-way move back. 18% increase in revenue and an 82% increase in income from operations to £1.45 billion. Mobility, as well as freight, mobility and delivery rather, has remained fairly even. So again, as long as they deliver on expectations, we could well see a move through $100.
Yeah, I would very much agree with that.
Okay. We've got Beyond Meat next week.
We're not mentioning that.
We're not mentioning that.
We'll leave that there.
I mean, to be quite honest, given the movements we've seen in that particular share price, the numbers are almost meaningless.
I was going to say, I don't think their earnings matter one jot, to be honest with you. It's one of those meme stocks that, basically doesn't make any money, but people are going to buy it anyway. But whatever.
Okay, so that's pretty much it for this week. As I say, we've had a lot to get through. we'll have a look at Apple and Amazon's next week. They're tonight.
Definitely. Yeah.
Thursday night or last night if you're watching this from Friday.
Yeah, true.
In the meantime, have a great weekend, and we'll speak to you all same time, same place next week.
Indeed. Bye for now.